Hello and welcome to episode 82 of Mo Money, the investing economic show for millennials by a millennial, where our goal is to educate, entertain, and empower a new generation of investors. I am, of course, the host of this wonderful show, MC Mo. Now let's get to the money. This episode, we're going to be talking about a very spooky thing. Unfortunately, I didn't get a chance to write about this a few weeks ago for Halloween, but I still wore my very cool skull jacket. We're not going to be talking about witches, warlocks, vampires, ghosts, mummies, or trolls. We are going to be talking about zombies. Now, not the kind that you know from The Walking Dead or Zombieland or any of the 1,000 zombie movies and shows that they've made in the past. The zombies we're talking about in this episode are the ones who roam the financial world. Zombie firms have exploded in the past decades, going from about 2% of total listed firms in 1987 to as high as 16% today. A zombie firm is a company that is publicly listed, more than 10 years old, and are able to cover operating and debt expenses, but are unable to pay down the principal of their debt. So at this point, you're probably thinking to yourself, cool statistics. What's your point? Why are you wasting time making this video? Why are you taking up valuable storage space on YouTube's database with this video? Well, in our last episode, we discussed moral hazard that is present within the financial markets. The rise of zombie firms are a consequence of moral hazard. The producer of this moral hazard are central banks, the Federal Reserve in the United States, the European Central Bank, the Bank of China, and the Bank of Japan, just to name a few. So how are they producing these zombie firms? Well, just like real zombies, these zombie firms are being created by magic. Essentially, the Federal Reserve has the power to manipulate interest rates throughout the financial markets just by changing the federal fund rates, which we discussed in episode 38. But just as a quick recap, the federal funds rate is the rate set by the Federal Reserve, and it is the rate at which banks lend reserves to each other overnight in order to meet reserve requirements. This rate is used as a benchmark for all other rates across the market, whether it be mortgage, auto loans, business loans, etc. After the financial crisis in 07 and 08, the Federal Reserve cut the federal funds rate from 5% to 0%. This basically meant that money was free. Interest rates are essentially the price of money, because that's the extra that you pay to get the money that you need now, instead of when you saved up for it. Since money costs little to nothing to obtain currently, many firms can easily obtain a loan, which is a good thing after the financial crisis. The Federal Reserve wanted to get the economy rolling again. The problem is, after almost a decade, the current federal funds rate is 2.25%, which is higher than it was, for the past 9 years, but still not at a level where experts would like it to be this far along in a recovery. You have these zombie firms who are consistently losing more and more money with little hopes of becoming profitable, but are able to stay in business because banks are continuing to loan them money because they are at least paying back the interest. There are no positive effects for keeping inefficient firms alive, but there are a lot of negative effects to doing such. The problem with these low interest rate policies that create these zombies firms is the misallocation of capital. In a competitive marketplace where interest rates are not being manipulated by central banks, a lot of these firms would immediately just go bankrupt because they are not making money and it would be too risky to lend them money to continue operating. But since that is not the case in our current environment, these companies are able to obtain the money because it is low risk for the lenders. Let's make up a hypothetical company, an electric car manufacturer called Edison. It's losing a lot of money, but it's predicted to one day be profitable, but currently it's not. So we have Edison, this electric car manufacturer, and it's spending hundreds of millions of dollars and not making nearly as much, but they are able to keep operating because people are continuing to lend them money because, again, money is cheap. What's the big deal? They're saving the world. Sure, but the problem is Edison is sucking money away from another electric car company who could be more efficient and be able to make profit and meet their goals. Also, Edison is unable to give their workers raises because they don't have the money to do so. Edison is not able to update their technology since they're barely making it along. Wage stagnation, outdated technology, lack of productivity, all of these negative effects are caused because the market signals are being interfered with by these low interest rates. The low interest rates are not allowing the market signals to properly identify who is a risk and who is not. So how do we kill these zombies? Well, unfortunately, the answer is not pretty, but it is necessary, and the process is already underway. The Federal Reserve, although slowly, is beginning to move interest rates higher and higher, even if President Trump pushes back against it. But we are 10 years into a recovery, and there's no reason why we should still be at such low federal funds rate. To raise interest rates to historically normal levels too quickly would be dangerous, and it would shock the market. To do it too slowly causes more and more debt to be undertaken, and you're really just kicking the can down the road, and firms would become more and more over-leveraged. It is a delicate dance that must be done, but the higher the rates go, the more zombie firms that will have their heads cut off by the rising interest payments that they are unable to pay. There will be firms who will go bankrupt, and there will be thousands of people who will be losing their jobs. But at the end of the day, the financial markets are Darwinian. The weak die and the strong survive. New companies who are more efficient and more profitable will take their place. Jobs will be created, and hopefully interest rates will not be interfered with in this process. Thank you so much for watching another episode. You can find new and classic episodes of Mo Money right here on YouTube. For now, don't forget to like, comment, subscribe, share, follow me on Twitter, follow me on Instagram, like me on Facebook. Mo Money signing out.